Buying down the interest rate using mortgage points. This video will cover what exactly are mortgage points, how are they calculated, and how do you know if they're right for you. So mortgage points, what are they? So mortgage points are a percent of the loan amount. So mortgage points aren't always an even number. They're not always 1% or 2% or 3%. They can be 0.25% or 0.75%. So I'm going to give you a couple of examples. But points in general, a percentage of the loan amount that's charged, you can consider it buying the interest rate down to a lower amount. So when you pay points, it's a one-time closing cost paid at the time of closing, and it lowers your interest rate to a certain amount permanently for the life of the loan. So there's a lot of savings there. So I'll teach you a quick way to calculate to know, are these upfront costs gonna benefit me for how many years? When is my recoup time? So that's what we're gonna learn in this video. So lower rates are great, right? Of course, everybody wants lower rates, but you gotta look at the fine print and the calculation. So let's check it out. This is an example, and it's not a real live interpretation of exactly where rates are, depending on when you're watching this video. So let's take a loan of $300,000, and let's say that the interest rate is 6.5%. Now, that's the interest rate without any extra costs to it. We call that a par rate, or just baseline. You can call it just break even. So let's say you wanted to look at lower rates. So Jennifer, how much would it be to get my rate lower? So let's say that the lender was offering you 1 point. Now I want to make a sidebar here. Points are called different things. You might hear the terms origination fee. You might hear the word discount fee or discount point or origination point. So lenders can call it either one of those things, but the real true story is that they mean the same thing. It's just got a different packaging on it. So let's take an example of a $300,000 loan. And let's say that the baseline rate is 6.5% and you want to buy the rate down. Let's say the lender is offering you a 1% point. Again, it could be called origination or it could be called discount. That's 1% of the $300,000 loan amount. So that calculates to $3,000. Now I did some quick math and I came up with the payments at 6.5%, which is what it would be with no buy down. And that number is $1,896 per month. Now by paying the 1% or that upfront $3,000 in this example, you could potentially get a 6.125% interest rate. Now that payment is $1,822. So I'm going to take a pause for a minute because you're probably wondering, Jennifer, if I'm paying 1% upfront, doesn't that get me 1% in interest rate? Shouldn't my rate go from 6.5 down to 5.5? Unfortunately, that's not how it works. It gets a little bit more complicated. Even I sometimes, being in the business so long, don't understand it. But it's called basis points, and it's how stocks and bonds are traded, basis points on the secondary market. So without going into all that, just know that the 1% fee that you pay up front is not equal to the reduction in the interest rate, okay? So let's say in this example again, you're paying $3,000 to go from 6.5 to 6.125. The difference in that payment again from $1,896 to $1,822 is $74 a month. So I take the $3,000 that it cost and I divide it by $74 a month that I would be saving. And that gives me a recovery time that's 40.5 months. So what that means is that that's 3.5 years, okay? So 3 years times 12 would be 36, a few more months, that's 3.5 years. So your thought needs to be, am I gonna be living in the house for that long? Or do I have a suspicion that interest rates will be lower before then and I might be refinancing? So I can tell you that in the 27 years that I've done loans, I have seen about 8 or 9 large reductions in the interest rate to make refinancing worth it for people at that time. Now, I don't have a crystal ball. This is not a prediction. I can just tell you that from my experience, rates will probably go down. Doesn't matter when you're watching this video, but rates do fluctuate over time. They go up and then they also go down. So these are the things that you should discuss with your local lender. If 40 months is the math on the recovery time between the points that you're paying and the money that you're going to save, it might really be a good idea for you. Now you can buy even lower than the 1%. You can pay 2%, you can be 3%. But the farther you go down, sometimes it's like a law of diminishing returns. You don't get as much of a spread, or in this case that we did, it went from 6.5 to 6.1, which is a 0.375 jump or reduction. But as you go farther down and farther down, it actually becomes more expensive to take a smaller step. So make sure you talk to your local lender, see what's best for you, let them give you examples. The purpose of this video is to just be empowered with the knowledge so you know and have some vocabulary on the questions to ask. I would love to hear your questions in the comments below. And if you're liking the channel and want more real facts, no BS about everything mortgage, please subscribe. Talk to you soon.